Thanks for tuning into this earnings conversation with LTIMindtree. Nachiket Deshpande Johnson to talk about what arguably was a tough quarter, but you would reckon that that's been true for most IT companies. Quarter three is seasonally a weak quarter. However, the margin disappointment would probably stand out as one of the key factors this quarter. Nachiket, good having you. Thanks for joining in. I'll come to the margins in a moment. Firstly, good having you, of course. It was anticipated to be a weak quarter, Nachiket, but did this 1% or 1.5% constant currency revenue growth disappoint you as well?
It does a little bit. I think as we said in our earnings call as well, I think and many of our peers also have called out this year the furloughs were a little bit too deep and too long. Some of the customers had month-long furloughs, which is normally not the case. So that definitely came in as a surprise as the quarter started developing. And you see typically financial services would have been the one which normally has more furloughs. This time, even the tech sector had a larger furloughs than what we had anticipated. So that's really where some bit of that disappointment came in.
And is it too early to figure out whether client conversations will lead to a sharp course correction in that? I know there will be a course correction for sure in quarter four. Will it be sharp enough, or is it difficult to say that right now?
I think it's in a way what we are seeing our clients do, Neeraj, is that they are definitely sort of examining their spend, right? So there's a lot of rebalancing of that budget happening in many customers, right? So I would say that while the conventional or the discretionary spend, which was seen a significant amount in the last 2 years, is starting to get a little bit soften, but a lot of cost takeout conversations have started, which kind of would have taken a backseat over the last 2-3 years. So I would say it's a rebalancing of the conversation. So from our perspective, specific client situations, if we are able to marry these two things together, so most clients are very keen to continue their transformational journeys because I would say almost all of them are somewhere in that journey, right? Nobody has genuinely finished that journey of transformation, and hence there is a need to continue that because the ROI will come only when they are able to finish those journeys, whether it is cloud adoption, whether it is data related journeys, whether it is experience or customer experience transformation journeys. So as what they are now looking at is now where do I find the money in order to continue that transformation? So our opportunity, in my view, is where we are able to balance these two conversations and help our clients find that money and reinvest that back into the transformation. And that conversations have actually significantly increased over the last quarter. And we see a lot of such deals in the pipeline in the making. So as we get into Q4, we are seeing a very good momentum on that. I mean, I think we called out our deal pipeline also healthy because the deal pipeline is made up of such opportunities where we are looking at striking that balance in terms of finding that cost saving and reinvesting that into continuing transformation.
So two questions rolled into one. Would some of these fructify necessarily in or largely in about 3 months time? So therefore in quarter four, or it could take longer. It could take 2 or 3 quarters as well.
So we are seeing actually there is a good deal momentum which are expected to close in Q4. So it's not very distant, right? So Q4 means next 3 months for us, like calendar Q4, which of course the revenue will show up more in FY24 because it would be in the contracting transition, all those typical sort of prep that will be needed. So the revenue part of that, those kind of deals will show up in FY24. But we're seeing a good traction in this quarter itself. It was not unlikely to take 6-9 months kind of a thing. We're seeing that opportunity here and now.
Okay, so both deal making as well as revenue growth could well see course correction quite significantly in quarter four. Not that deal making was terrible in quarter three, but I'm just saying the furlough-led revenue miss will anyway show a course correction. And what you're saying is that because these conversations will close, it will kind of augur well for FY24 revenue growth.
Correct. So I think that's why we even called out in the earnings call. I think FY24 we are definitely confident to be in that leaders quadrant from a growth perspective. That as both the companies individually have delivered that, which we believe we have the opportunity to do that, and we see the path to doing that in FY24.
Got it. Though the margin hit, would that take a lot longer to recover because it was a fairly sharp one?
Yeah. So there is, I mean, I think we explained that in the earnings script as well. There are two parts to the margin related mess. One is, of course, the seasonality, which is the furlough and less working days. Then there is, of course, an integration expense that came in Q3, a substantial part of that. And then there is some employee cost increase with ESOP and few other things. And also, as we sort of brought both the teams together, there are some inefficiencies in that model that in the first quarter, because it's only 6 weeks since the merger, right? So some of that fine tuning of various functions will take a bit. So those were the impact items for us in Q3. Now, if you look at that, we believe that a good portion of furlough is behind us. There is some that is still spilling over into Jan, but not a whole lot. So that is expected to come back. Even integration expenses, a large part is coming in Q3. There are some residual parts that will come in Q4, but again, not to the same extent. And also some of those inefficiencies that were there as we were becoming the teams together, we've identified and we started to streamline those. So as we look at Q4, we believe 200 to 250 basis point of margin will come back in Q4 itself. And we believe as we go into FY24, we should be able to operate at the margin. The par margin was there for both companies together. So what we were delivering previously, we would be able to return to those levels in the FY24. Of course, not in the first quarter, but if we look at a full year performance, we believe our endeavor is to get into that same performance. And then, of course, as we called out, over the next 2-3 years, the margin synergies of the mergers will kick in, which is what we have looked at, where we would genuinely look at leveraging our economies of scale, right, as we become a larger organization. So that sort of is a 3-step roadmap, so to speak, right? Some of that will return in Q4. We get to our expected performance, so to speak, in FY24, and then over the next 2 to 3 years, you will see the margin improvement on the back of synergies coming in.
Yeah, that's a much stronger assessment you're giving than what most brokerage notes that have come out this morning are penciling on the margin. So that's actually good news. One more question would be on talent. Now, you, of course, incurred staff cost, ESOP-led cost. The belief is that the peak problems of employee-related retention issues as well as other things and margin issues are behind the industry. Would you second that? Would you believe things will only improve from here?
Yes, if you look at even our in-quarter attrition, that's come down almost by 650 basis points. So that's a sharp decline in the Q3. And the LTM would take a couple of quarters to show, but if I look at in quarter, which we normally don't report, but we called it out in this earnings call as well, because there is a material change in what we see in quarter attrition. And I think it's again comparable to the other peers. They've also seen a similar reduction, similar order of magnitude reduction. That will also mean that there is as I think we have said in the past as well, large part of our cost inflation was less about increments, but more about replacement cost of this attrition, right? Yeah. That was playing a bigger role. So that cools off as we go into, and even in Q4, if I look at resignations in the system, that seems to be sustaining from an attrition levels seems to be sustaining at a lower level. So yes, I think at least those issues are behind us. The premium, though, is still there in certain skill set, because the demand supply mismatch for certain skill set is not, we can't wish that away so quickly. Some amount of building of skill set has to happen, which is happening in the industry, will take some time before that completely rebalances. But a larger scale related issues that we all faced in the last 2-3 years, I think we can say it's behind us.
My final question, and most people believe, and it's been seen in the past, that when two large companies, and both the companies individually were large enough, come together, merger synergies, etc., and issues take time for the combined entity to be able to give visibility, strong visibility of growth in the first couple of years. You reckon you will get over that hump quickly, or is it difficult to predict that right now?
No, I think we are looking to get over that hump quickly. So our endeavor is, as we complete our Q4 and when we give all of you are sort of plan for FY24, we should be able to give you more color on where that synergies will come from and what quantification could be. And the reason for that, Neeraj, is that unlike some of the other mergers, while the size was equal, we were very complementary to each other. So there's hardly any overlap, right? Amongst the 700 clients that we now have as a combined entity, only 8 or 9 of them were the common clients. So with that, if you see our org structure, especially in the middle layer where people are managing clients or managing deliveries, that structure has been additive. There's hardly any overlap. We didn't have to choose A versus B, right? So that structure being additive, that strength of getting that input from that layer on what's happening in the individual client situation and how we participate that is not delayed. Typically, when you have those changes, when new people are taking over client relationships or delivery responsibilities, that's where it takes time because they take time to understand the portfolio before they can respond to that. Here, there is a lot of that stability. It's the same people that are driving that across both. Maybe at an N-1 level, there are newer responsibilities, but the bulk of the team, which is in a way responsible for giving us that intelligence, is still the same that did that for the last few years. So I think we are able to synthesize that and to be able to translate that into our strategy quickly as we get into FY24.
We wish you all the best for that, Nachiket. Thank you so much for speaking to us and look forward to talk to you at the end of Q4.
Thank you, Neeraj. It was very good talking to you as well.
Likewise, and viewers, thanks for tuning in.